I'm Brendan Yurik, the CEO of Electric Royalties, a royalty company focused exclusively on the clean energy metal sector. We've got 22 royalties in our portfolio, really looking for royalties on those deposits in North America, Europe, and Australia that could fit the bill to be domestic sources of supply for these metals for the decades to come.
Good to see you here, man.
Good to see you, Matt.
Look, PDAC's on. You're kind of treading the boards, as it were, shaking hands and meeting people. How is it over there?
A lot of people this year, so that's exciting. I think the mood is, generally the funding is not going where it probably should be. So there's, I'd say, quite a bit of lack of funding. Obviously, crazy times, with nickel prices going where they are, lithium prices and all that. So gold doing quite well though. But yeah, generally, I think people are excited about what's coming, but at this moment in time, it's a little bit subdued.
It is. I think it is a little bit subdued. And let's talk about royalties, right? Because I'm a big fan of royalties. I think you need a royalty in part of your portfolio in some way, shape, or form. So no problems with that. Big fan. But you guys need to focus on the basics. You got to do deals. You got to bring in revenue. You also got to be looking at how when the next bit of revenue is coming in. So I want to go through bits of your portfolio, if you don't mind. People can go onto your website, look at the deck, and take a look at the list there in terms of production, development, exploration, etc. I couldn't help but notice the two producers paused.
Yeah.
Revenue paused.
In November.
What's going on?
At the same time. So our Penouta Tin royalty, we financed twice last year. Really Europe's only tin mine. They're only producing tin mine. So we financed them twice last year. They had to shut production basically around November. There's a permitting issue, and so that's gone to the courts. I think we're going to see some positive news come out of that.
Okay.
Quite frankly, I've talked to management quite a bit about this. There's a reason why we chose that management team to invest in.
Right.
They had supporters, protesting in support of the mine, which I don't think I've ever seen before. Yeah, not protesters against the mine, but mass demonstrations in support of the mine.
Right.
So I do think that we'll see some positive news on that. The next little bit.
So let's be clear. So a permitting issue over what?
They had their permits revoked, and it was over. They've been mining there since the ancient Roman times, and so new group starts mining there. Stuff that's historical, gets brought up by people, and so that was brought to the courts, and they took away their permit temporarily. That's being appealed right now, and we are hopeful that we'll have some positive news on that, here in the next month or so.
What was that worth to you, revenue-wise?
That was about, we were expecting about $500,000 a year from that.
Okay.
Yeah, so our G&A is only about $1.5 million a year, and so that was 1/3 of our pathway there.
Okay.
We see that royalty actually expanding in cash flow. They have an opportunity to double production to that mine once they get their permits back, obviously, but they need to raise some money for that.
Okay, so they're appealing. Nothing technical, nothing wrong with the deposit.
No.
This is pure
permitting issues. Yeah.
Unbelievable.
Yeah.
And that's right. Okay, and pause number 2.
Yeah, our zinc royalty.
Same month.
Yeah, I know, same month.
Right,
so that was the Middle Tennessee zinc royalty.
Yeah.
Trafigura owns that. They temporarily suspended production, due to zinc prices, but also to basically spend that time drilling out the deposit, positive for the longevity of the asset, and also to put in a germanium and gallium recovery unit. And so germanium and gallium prices have been going a little bit crazy here over the last couple months. So that's a lot of incentive for obviously that to come back in production soon. And zinc prices, I don't think it's sustainable where they are today. If you talk to any of the guys actually producing zinc, the Tech, Glencore, South 32, those guys are very bullish on zinc over the long term, and that's our view.
Okay, so this is not shut down. It's not care and maintenance. It's not a walk away job. It's we got some drilling to do.
Yeah, some drilling to do, some work on a recovery
extension and recovery of additional byproduct.
Yeah, gallium and germanium, which there's quite a bit at that mine. So
right, okay. Let's go to the next tranche of revenue. This is really important, because you go and pick up decent royalties, but the expectation is that it actually delivers revenue, right? Okay, so near-term revenue projects.
And so that one, MTM, was about the same, equal to what cash flow we'd expect from Penouta. So yeah, between the two, we're getting to kind of 2/3 of cash flow, sustaining at least.
Okay. Talking about all the lithium stuff that you picked up. Okay, it looks like you've been rejigging things a bit. Because of the market, maybe?
So we did announce a deal back in November.
Yeah.
We signed that with 5 months exclusivity. Yeah. And obviously the market has, not really improved much for lithium. And so, yeah, we definitely are working on a new deal with those guys, whereby, of the 126 properties we're acquiring, 22 of those are already royalties.
Right.
So we're definitely going to acquire those. That immediately doubles our royalties number to 44, which I think is pretty exciting. We love that area of Ontario. I think there's a lot of lithium there. The lithium market right now, yes, it has gone a little bit crazy to the one side.
Yeah.
There was so much money came in, so much hype. Everybody was exploring. There was so much capital coming into the space. I think valuations got a little crazy, and you've seen this little bit of oversupply right now. But it's a new market. It's a brand new market.
Yeah.
That's going to happen. When it's a brand new market, you bring one mine on, makes a substantial impact, right, to the overall supply. But we love this market. Over the next 2 decades, I think the prices that you can get on these assets now, it would be 1/50th of where it would be, 2.5 years ago, if you see what stuff was trading at back then. And so we're a long-term player. We're a royalty player. We think development's going to happen faster there. But instead of 126 properties, a lot of those were unoptioned. We are definitely going to narrow that down. So we're going to kind of hand pick a smaller number of those. But we expect that the cash flows from those option payments are going to pay for not only the royalties we're acquiring, but also these option agreements that will turn into royalties. So,
right.
we look at it as a very low risk deal. We're not putting too many eggs in one basket, I don't think, in terms of lithium. But we love hardrock lithium, Eastern Canada, and it's a great way to increase exposure.
Right. I mean, can you talk to me about what that does in terms of the economics for you? Because obviously, it was a chunk of change. Back in November when it was announced.
Oh, yeah.
Okay, that's a lot of money.
Yeah.
So would you save any money now?
Yes, definitely. So our cash cost on this is going to be significantly reduced. Initially, our overall cash cost was about $4.5 million.
Right.
We've more than cut that in half. So we're expecting, the overall package at the end of the day will cost about $2 million cash.
What's that do in terms of payback time?
So it should be about a 2.5 year payback because the option payments we expect back just from the 38 or 36 properties, whatever we choose. That will actually pay us about $1 million this year, $1 million next year, roughly. So the payback's actually relatively quick. That could be spread out over a little bit, an extra 6 months, but all within about a 3-year period.
Right. So in terms of, I guess, cherry picking the ones that you do want, what's the kind of criteria for what you pick and what you leave behind?
Yeah, well, definitely we're doing, geologically, there's a few places that we love where I think a lot of the discoveries are being made, where we, see a lot of work being done, there's more interest. So that's definitely something that we're going to be paying attention to. And then also kind of cross-checking that against, who the operators are. Do they have good management teams? Do we think that they're going to be able to continue funding this, throughout the cycle? So between the two of those, that's really kind of the main, target.
Okay, and where else should we look? Like, I mean, I don't want to kind of rip through, as you say, 44, royalty. Oh no, how many would that be?
Well, that would be 44 with a path to, growing organically to about 80 without us doing anything.
Okay, so let's not do that. Let's focus on what's important to you, or what you think is important in terms of, one, ability to get to revenue, because that's the topic of this conversation.
Yeah.
Within a reasonable time frame, and I guess a little bit of scale to that as well.
Yeah, for sure. So we have those two producing royalties that have temporarily suspended production. We expect those will be back in production, in the near term. With this deal, we're also adding additional cash flow. Between those, coming back online and this deal, we'd be cash flow positive because our G&A is so low. We also have Graf Mata, which has been on care and maintenance for the last, 2.5, 3 years. That could come back online very quickly. And that group is just...
Why'd you say that?
Well, they really need the capital to get it back into production. Management team has kind of been focused on some other stuff. They need about $25 million to put that back in, but they qualified all of their product off-takers. They were operating continuously for about 20 months. So that's a huge step in the graphite space. And that would be a significant contribution as well for us. Our Authier Lithium royalty, that'll be the next lithium mine to go in production in Quebec. It's in final stages of bait permitting process. Seymour Mining, who's in production already, they're planning to basically blend ore from that project to ramp up production. Our Seymour Lake royalty, they're looking to be the first lithium mine in Ontario. DFS should be out later this year. So they're really fast tracking that project. They just put out a production profile. It's around 200,000 tons a year, somewhere in there. And we've got a 1.5% royalty on that. So I'm not sure if I can do the math for you guys on that, but it's a very significant amount of cash flow. We've also got our Northern Graphite royalty on Bissett Creek, which we actually just increased at the end of last year. That royalty, that mine is going to have a life of 70 plus years. That's how many resources they've got there. It's well situated in Ontario. They're one of the few graphite producers outside of China. And they're slating production for 2025 and have talked about increasing production up to 100,000 tons per year, which is that's a 4x, where we thought it was going to be initially.
Yeah.
So that would be another significant royalty. We think that would be around $5 million a year once in production, fully ramped up. So there's a number of different royalties. Manganese X, our Battery Hill royalty.
Yeah.
The PFS should be out on that very soon. There's been a number of royalty financings in the manganese space. I mean, that one was $7 million a year, 49-year mine life. So that would definitely be another one. And then Mont Saucier, they're partnered with Glencore on that project. Feasibility should be out later this year, early 2025. That again was a 30-year asset that we were expecting to pay us about $1.5 million a year. So, I mean, there's so many different royalties in our portfolio. BHP is drilling our Rana project in partnership there with Kinrose, who's fully funded for that. So lots of good stuff going on. I mean, I could keep going. We have work ongoing on most of our portfolio.
Right. But I guess what we're trying to get a sense is kind of build up a profile of what could be. I know it's difficult for you to do that. Exchange might have issues with you doing that.
Yes, most certainly.
And the companies themselves, aren't necessarily going to hit all the targets that they think. So I do appreciate that, but maybe a little bit of work from people when they're reading this is essential. In the meantime,
well, royalties are very simple to calculate, though, too, right?
What's going on? I know you've got a page in there which says...
Yeah. So most of our royalties are gross revenue royalties. Yeah. So essentially, if you can tell what the annual production is at a project, and you know what our percentage of royalty is, which we're more than open about, you can essentially pick your commodity price that you want to use, where you think the forecast will be. You times those three numbers together, and that would be the annual cash flow you'd expect for one of our royalties.
Right.
So it's very simple, if people want to go through and actually calculate it. And that'll give you a direct, exact,
I think
there's
a page in your PowerPoint which actually helps you through those baby steps to do that. So go and do that. If you're interested in royalties, get royalties in your portfolio. If you like the EV thematic, this might be a company you should look at. Okay, so we'll say that. You need to think of... You need to be in control of some of those components. You picked up some royalties, and then the companies are in control of the timing of that, right? But it's a common. But in the meantime, the other thing which excites the market is your ability to do transactions. You've just tweaked your convertible facility a bit recently as well, I noticed. Yeah.
So we haven't raised equity in a while. We're very sensitive about that. My family is 15% shareholders in the company. I'm personally invested 95% plus. So we've been very sensitive about that, especially given our valuation. We think we're grossly undervalued. So we're very lucky. We've got a very supportive shareholder, Stephen Gleason. He has basically increased our credit facility with him up to $10 million. We've only drawn 4.5 of that so far, but it's very friendly terms. There's no payments of any kind for 4 years. That's interest payments, capital payments. It's all convertible into shares at a much higher share price.
At his election, his or yours?
At his election, at his election, but it's over a 4-year term. So we've got lots of time on that. I think eventually it's going to make sense, especially given where we are today. And then we don't pay any money on undrawn funds. Interest rates capped at 12%. So I think it's very, very favorable compared to anything else you'd see out there, and of course with our largest shareholder as well.
So if I think about how you run companies, how one must run companies, obviously, being careful arbiters of cash is critical here. But you've also got and given the 4-year time frame there within that convertible or the terms of that convertible, you'd hope you'd run into the next phase of the cycle, which is more up than flat or down as it has been. So that would do a lot of heavy lifting for you. But at the same time, with that money, additional money, which would be, I guess, in terms of what you can access, is like $5.5 million to go of that. You might have to do something a bit cute. You might have to do something and work out what the hell that thing is of what do people value in royalty companies, right? Which may not be the most efficient thing that you could do with the capital, but it might be have the biggest result for you. So what could that thing be? What do you think people value? What's the smartest thing you can do?
Well, there's two things to that. So there's one would be, if we ever had to raise equity somewhere, I think obviously we're not getting value for the full components that we have. And so if you look at some of the royalty financings happening in the manganese space, look at our Battery Hill royalty, that royalty alone, given some of the comps, could be the value of our whole company. So I think there's an opportunity to sell some of our royalties or a part of some of our royalties. As one option, try and capture some of the real value, for one of the assets held. Second to that, I think it's always going to be cash flow. Everything that we're looking at right now is cash flowing. even this deal we're buying 22 existing royalties to 38 option properties, there's cash flow element, involved with that, at least for the next couple of years. I think there's going to be a great opportunity really this year to go in with groups that are putting themselves into production who are going to need extra capital. And our plan would be, to be there to be that kind of stopgap funding. And I do think there's other capital, willing to come in. We did that co-investment with Sprott on our first producing royalty. I think there's a number of groups, a lot of money out there looking for that kind of stuff. And so hopefully we'll be able to do something, like you said, a little bit cute.
Yeah.
I call it cheeky, but something along those lines, yeah.
Right, okay. Well, look, I think it's, thanks for the catch up, and it's good to see you.
Yeah, you as well.
Finally, right, get that done.
Yeah, since London, yeah.
Yeah, and we just want you to do well, because I think it's the right thematic, the right idea, and the execution's been okay, but we're looking for that next step change from you, and I don't know what that is, and it may be market connected or maybe deal connected, but we want to see you do that. So I appreciate you coming in and saying, man.
I appreciate that, Matt. Yeah. You're going to see it this year.
Cheers.
We're at 44 royalties. We'll get there.
Good.